today we will continue with the FAC2061. Yesterday we started with the introduction to financial statements. We looked at the purpose of financial statements and we looked at the uses of financial statements. We had examples as to the uses of a financial statement and which part of the financial statement is going to be important for them. So we looked in the high levels, we looked at the Companies Act, the link between Companies Act and preparation of the financial statement. Today we will continue with what is called a conceptual framework. So what underlines the preparation of financial statement? When we are preparing the financial statement, what are the things that we should take into account? What are the fundamental building blocks of a financial statement? So that is what we are discussing now. So yesterday's one was an overview in terms of the IFRS, the body that governs the preparation of financial statement and the uses of financial statement. Today we bring it home a bit by getting it smaller. So we now explaining to we're now getting into the nitty-gritty of how to prepare the financial statements. So today we're going to talk about the conceptual framework. What conceptual framework does is that it gives us the building blocks, or it gives us the concepts on how financial statements should be prepared. So this is also a very, very important topic for FAC2061. So we will start off by looking at the conceptual framework there, just to say that conceptual framework is not a standard. It's not an IFRS. It's not International Financial Reporting standard. It just gives us concepts on the building blocks or the concepts on how or the underlying assumptions to prepare financial statements. So we'll be looking at objective of financial statement again. We'll also look at what are the qualitative characteristics of a useful financial information. Before a financial statement can be useful, what are the underlying assumptions that can make our financial statement to be useful? We'll look at the reporting entity. That is, we'll be looking at these from the reporting entity's point of view. We'll look at the underlying assumptions in preparing financial statement, like I've already said. We will also look at the elements of the financial statement. What are the elements? When we talk of elements of the financial statement, what do they mean? What do they mean? So today we'll go into more details into looking at the elements of the financial statements. We'll look at recognition and measurements, recognition and derecognition principles. When do I recognize an item on the statement of financial position? When do I recognize an item on the statement of profit and loss? What criteria must be in place before I can recognize an asset or a liability or an income or an expense? We'll look at measurements, measurement principles. What do we mean when we talk about measurements? Then we'll look at presentation and disclosure. So in preparing the financial statement, you have to present and you have to disclose. What do they mean? When we say present, what does presentation mean? What does disclosure actually mean? And we'll look at capital and capital maintenance. So those are the things we're going to be discussing today. And like as usual, it's going to be an interactive one. It's going to be question and answers. I'll ask questions and I'll expect a response. Just try your best. There's nothing like a stupid a question or a stupid answer. You know, try and answer it. Even if you don't know, just try your best, because you asking the question or you answering might actually be able to help someone. There's nothing like a stupid question. Right, so we will begin. I will be flipping from the slide onto the chat just for me to see if maybe someone has posted something there that we can read. Cool. At any point in time, please ask me questions. At any point in time, stop me, ask me, or raise your hand up or something just to ask me questions at any point in time. Like I said, I'm facilitating it, and I'm hoping that you guys have done your pre-reading and that you are here to actually ask me the questions. you know, and that we all learn together, you know. Good. Some of the key concepts that we will be going into detail will be an assets. We're going to define what an asset is. An asset is found in the financial statement. What is an asset? What do we mean when we talk of an asset? What is it? How do I know that this is an asset? Liability is the same. How do I know this is a liability? What is the definition of a liability? You know, so we're actually starting from the basics, you know, and we build. By the time we get to next week, we're already doing calculation. We go into IS2 inventory, we go into financial instrument, get into detail, get into journal entries, get into disclosure and the whole lot. So these are this is the foundation. So it's very important. Cool. We'll look at equity. What is equity? We see equity on the statement of financial position. What does it mean? What is it? Where do I find it? What does it mean to me? What does it do? Income as expense. We'll learn about the definition of income and expense. We'll learn about recognition. What is recognition? When we talk about recognition in accounting, what do we mean? De-recognition. What is de-recognition? Very, very important. Control. We will talk about control. When we look at the definition of an asset, there's a control element in there. What does control actually mean? And you guys are going to be doing the answering, eh? So we are going to learn together. We're going to ask ourselves questions, and we're going to, yes, we will do it together. Then right, we talk of right. What does the right mean? The right. Then the going concern assumption. What is a going concern assumption? And then lastly, there's also one key concept called materiality. What is a materiality? Auditors like to use the word materiality. What does it mean when we say something is material or something has got a materiality figure? What does it mean to us? So these are the concepts that we are going to be tackling today. And by the end of this class, you will have gained a lot of knowledge. If you add it to what you know already from yesterday, you will be on your way to prepare serious financial statements. Good. Cool. So once again, what is the objective of financial reporting? Why do we report? Why do we prepare financial statement? What is the main objective? The main objective of financial statements.
The main objective is to report on what is happening in the business in terms of income and expenditure of the business.
Okay, good. Is it only income and expenditure? Is that the only thing that we report on? Is it only income and expenditure? What you said is not wrong. It is right, but the other thing that we see in the financial statement, right? So apart from income and expenses, what else do we see?
Assets and liabilities.
Assets and liabilities.
Owner's equity.
Owner's equity, which can be found where?
In the statement of financial position.
In the statement of financial position. Good. Good. So it tells us that. And what does those information tell us? So it gives us where we stand in terms of our performance, right? So the statement of profit and loss tells us in terms of our performance, how we have performed, because it tells us whether we have a profit or a loss. So we have all our income, we have all our expenses, and then at the bottom we have a profit or a loss. So it gives us some information about how the company is doing. When we go to the statement of financial position, we see our assets, all the assets that the company owns. To a user, it tells them that if the company has got lots of assets, so it's got resources for them to be able to use to produce income, right? If you look at the financial statement of a company, and they don't have a lot of resources, they don't have a lot of assets, you may wonder, will this company actually be a going concern? Will it be in existence in the next 2 or 3 years? But if you see the financial statement of a company has got lots of assets, then you can see that the company is actually in a good standing, right? Then we also have what the liabilities. It tells us how much we have borrowed. Too much of borrowing is not good, you know that. So if I'm a bank and I look at your financial statement and you borrow too much, I can decide not to give you a lot of any more loan, you know, because borrowing too much means that what you are also paying a lot of interest, which is going to deplete your cash. So it's very important that you manage your statement of your assets and your liabilities to make sure that they don't work to your detriment. Yeah, and also cash flows. Also, cash flows gives us an indication, right, of whether we have cash, actual fiscal cash on hand. Then we have statement of changes in equity, which also helps us or tells us the transaction that has taken place in terms of cash that has come into the company and the dividends that we have paid out. Good. So that is mainly what the purpose or objective of financial statement, to give us information. Good. Excellent. So to provide financial information about a reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. So basically, in a nutshell, it helps us to make decisions. It helps users to be able to make decisions about the company or the entity. Yeah. So this is exactly what we have said now. Same thing. Now, what is an accrual basis of accounting? Remember, this is the conceptual framework. One of the conceptual framework is it talks about accrual basis of accounting. What is it? What is this accrual basis of accounting? What is accrual basis of accounting? When the conceptual framework talks about accrual basis, what do you understand by the accrual basis?
I'll take a guess and say it records before things happen.
Sorry, come again?
It records before the payments are received. So you record the transaction before you receive the payment. So I'm assuming the payment will come later because the person that pays on your creditors and they have payment terms probably.
Okay, good. Good. So what you are saying is that the accrual basis of accounting records the transaction before the payments have happened, right? Good. Okay. Anyone to add on? Andrew said received. Okay. Yes, accrual basis. What is accrual basis of accounting? Oh, I thought it was easy. Accrual basis of accounting.
Oh,
yes.
Oh, hi. Oh, I sent on the comment. It's recording a transaction as it happens, whether the funds are received or not.
Okay, so recording transactions as they happen, whether the funds have been received or not. Excellent. Excellent. So the conceptual framework is telling us that when we are preparing financial statements, we mustn't think about the receipt of cash or the payment of cash. We must record the transactions as they have happened, right? We record the transaction when they happen and not when cash is received or cash is paid. So the payment of cash or the receipt of cash should not affect whether the transaction has taken place or not. As soon as a transaction has taken place, we must record it because the transaction has taken place. Whether there has been a payment of cash or a receipt of cash, it doesn't matter. That is what the accrual basis of accounting is. Right. Does everyone understand this? So when a transaction happens, you record a transaction. Don't take cash into account. Record a transaction as they have happened. So who can give me an example of an accrual basis of accounting where a transaction has happened and we are just recording it? We don't care whether cash has been received or not. Who can give me an example? Who can give me an example of a transaction that has happened and I'm recording the transaction, whether I'm not caring whether it has been received or paid. Sales on credit. Okay, so Maria, yeah. Sorry.
Buying goods on credit.
Buying goods on credit. Excellent. Buying goods on credit. Excellent one. Yes. Maria says that sales on credit. Excellent. So when I sell on credit, I sell to an entity. I'm not collecting the cash now. I'm only going to collect it later on. But because I've made the sale, I must record the transaction. Right? I must record that transaction. I'm not taking into account that whether I've received the money or not. It doesn't matter. The mere fact that I have made a sale, I must record the transaction. Good, excellent one. So what transaction will you put through to record a sales on credit? What is the general entry? What do I debit? What do I credit? To show me, to tell me that sales on credit has happened.
Debit purchase control and credit sales.
Good. Debit, debtors, debit accounts receivable and credit sales. Excellent. Excellent. So when I make a sale on credit, I must record that transaction, and it's a debit to accounts receivable. Why accounts receivable? Because why am I debiting accounts receivable?
You haven't received the cash yet.
You haven't received the cash as yet, so it's accounts receivable. Account money I'm going to receive in the future, right? So debit account receivable, and it's an asset, right? Accounts receivable or debtors is an asset. So when I debit accounts receivable, it means what? I'm increasing my asset. The fact that I haven't received the money yet, I'm only going to receive the money later. So debit accounts receivable. And what do I credit? I credit sales. I credit sales. Why am I crediting sales? Sales increases with the credit balance, right? Does it make sense? Should I repeat? Should I explain this journal entry again? Or is it clear? Sales on credit, debits, accounts receivable, and credit sales. Good. We're gonna do a lot of examples. By the time we finish the today, you will have recorded a lot of journal entries, just for you to think about, processing of transactions. Good, excellent. So that is a what? Accrual basis of accounting. That the effects of transactions are recorded when they happen, and not when cash is received or cash is paid. Not when cash is received or cash is paid. Another one would be what? Purchasing of an inventory on credit. So if I'm a company and I purchase inventory on credit, it's also what? Have to record a transaction because the transaction has happened. The fact that I have not paid money doesn't mean that I cannot record. Money doesn't matter when we are dealing with what? The accrual basis of accounting. Money only matters to us when we are preparing the cash flow statement. The cash flow statement says that only recorded when you have paid or recorded when you have received. So that is the cash basis of accounting. But the accrual basis says once the transaction has happened, you must record it. Good, guys. Excellent. You are doing so well. So let's look at an exercise. On the 1st of March 2016, a company purchased inventory on credit. The company has a policy of settling creditors after 60 days. Required. How and when should the company account for the purchase under the accrual basis? So under the accrual basis, when should this transaction be recorded or be recognized? At what date? Is it after the 60 days credit days? or on the 1st of March?
1st of March.
1st of March, excellent. By 1st of March, it should be recorded. By 1st of March, it should be recorded because that is when the transaction has taken place. The fact that we are only going to pay the creditor only
On the
after
1st of
60
March.
days. Yeah, 1st of March. Yes, thank you. The fact that we're only going to pay the creditor after 60 days, it shouldn't matter. The transaction happened on the 1st, we record the transaction on the 1st. And we say, what do we debit, what do we credit? What do we debit, what do we credit? A company purchases inventory on credit. A company has a policy of settling creditors after 60 days. And we are applying the accrual basis of accounting. What is the journal entry to record this transaction? Debit trade, okay, so Vusi is saying debit trade and receivable. Debit trade and receivable. Is that right? Are we debiting trade and receivable? I'm the company. I've purchased inventory on. Sorry?
Crediting payables. Accounts
You credit payables. Good. What do you debit?
Purchases.
Purchases or inventory?
Inventory. Yeah.
Yes, thank you. Excellent, guys. Excellent. So you debit inventory. Why? Because you have purchased inventory. Inventory is an asset. An asset increases with a debit balance. So you debit inventory. And because you did not pay cash for it, you debit what? Accounts payable. Because you're only going to pay it later on after 60 days or in 60 days time. So debit inventory and credit accounts payable. Excellent. Good, guys. So that is it. And then how and when should the company account for the purchase under the cash basis? So if we are not using the accrual basis of accounting and we are using the cash basis of accounting, when should this transaction be recorded or be recognized? Now we are on the cash basis, no longer accrual basis. When will it be recognized? Anybody? Now it's the cash basis. When will this transaction be recognized?
I think it should be recognized after 60 days when the money when cash is received.
Excellent. So under the cash basis of accounting, this transaction will be recorded in the books when the cash has been paid. When the cash has been paid. And what will be the journal entry? What will be the journal entry on the 30th of April, which will be 60 days, right?
Credit. Yes. Yeah, we will credit bank.
Yes.
We will credit bank and we'll debit. Is it inventory now?
Yes, inventory. Good. Excellent. Excellent. So on yeah, it is right. It's correct. 100%. So on the 30th of April, that is after 60 days, we will debit inventory. Still, we have acquired the inventory, debit it, and we'll credit bank. We will credit bank. We'll credit bank. So this transaction will not hit the cash flow statement until what? After 60 days. That is when it will hit the cash flow statement. So it will only hit the cash flow statement only when the cash has been paid for the inventory. Or if it's a sale, only when the money has been received. But under the accrual basis, as soon as the transaction has happened, we will record it. So in accrual basis, the transaction has to be recorded on the 1st of March. But under the cash basis, the transaction has to be recorded after 30 days, which will be on the 30th of April. 30th of April. Does this make sense, guys? Does everyone understand this? Does this make sense? Is anyone struggling with the journal entries? Do you understand why we debit inventory? Do you understand why we credit cash after 60 days? Good. Thank you, Tembani. Do you understand why we debit inventory? Good. Thank you. We will move on. Now, the conceptual framework. So the framework that guides us to prepare financial statement, which is not a standard, but it's just it's a guideline which helps us. It talks about qualitative characteristics. Qualitative characteristics. Who has heard about qualitative characteristics, or who has come across qualitative characteristics on preparing financial statement? Who has heard of qualitative characteristics? Anybody? So in preparing financial statement, the framework tells us to use what is called qualitative characteristics. So these are the characteristics that underline the preparation of the financial statement. Let's look at what they are. So they are relevant. So it's telling us that when you are preparing the financial statements, it should be relevant. It should be relevant, right? You cannot prepare a financial statement that was meant for us for this year 2023. You cannot end up preparing it in 2024. Then the financial statement is no longer relevant, right? You should give me the information when we're in 2023, not when we are in 2025 or 2026. Then you give me the financial statements for 2023. Then it's not relevant any longer. I will not be able to make decisions out from something that is not relevant, something that the date is past, is gone. How am I supposed to use it? So in preparing the financial statements, the framework tells us that it should be relevant, because relevant means that the users of the financial statement are able to make decisions from this. Anything that is relevant means that I'm able to make a decision from it. Whatever is not relevant means I cannot make decisions from it. So relevance talks about the ability for me to be able to make decisions with the financial statement. And that is why when a transaction happens today, you record it at the time it happens. Don't go and record it in a different accounting period. Because if you go and record it in another accounting period, then it's not relevant anymore. I will not be able to make decisions from that. And it also talks about faithful represented, that the financial statement must tell us exactly how the company performed. Don't be biased. Be neutral. Don't make errors. So that's what it talks about, faithful represented. The financial statement must be free from material error, and it must be relevant. So the two that I've highlighted are what is called the fundamental qualitative characteristics. That no matter what happens, financial statement must be relevant, and they must be faithfully represented. Faithfully represented means that they must be free from material error. They must not be biased. They must be truthful. Basically, they must be honest when you are presenting the financial statement. Don't lie. Don't make fictitious assumptions. Don't tell us that the asset was 40,000 when it was actually 100,000. So it must tell us exactly what has happened. That is what faithful represented means. Then we have other characteristics like comparable. Yeah, so the fundamental ones are relevancy and faithful representation. Then we have other characteristics. The financial statement must be comparable. What do you think comparable means? Why are they saying that financial statements might be comparable? Why do they want financial statements to be comparable? What do you understand by that term? Just guess. What do you think? Financial statement might be comparable. What do you think? Remember, there's nothing like a stupid answer. Just tell me what comes to your mind. Financial statement might be comparable. What does the word compare means? Compare. Anyone? Maria? Anybody? Comparable.
I think basically we just want to be able to identify trends.
Yes.
Like the performance, yeah.
To identify trends. Yes. And what else? Yeah, to identify trends, right? So we should be able to compare 2024 to 2023, right? And we must also be able to compare what? One entity to another entity. It should be comparable. Yeah, we should be able to compare. We should be able to identify trends. All right? Be able to compare one year to another. Therefore, it also talks about what? Consistency. Good. Then the financial statement should be verifiable. Can you verify? Can you verify the amounts on it? If you have said that an expense is 20,000, do you have invoices to tell me that the expense was actually 20,000? If you said the share capital issued was 100,000, do you have evidence to show me that the share capital was actually that amount? If I bought an inventory for 150,000, do you have the invoices to show me that the inventory was actually worth 150,000? So that's what verifiable means, that the amounts on the financial statement can be verified, right? Then timely. Timely talks about the relevance as well, that you should prepare it on time. You mustn't wait. You mustn't give me financial statement of 2023 in 2024. Then I may not be able to make, or I may not be able, it may not be timely, you know. It should be timely. Things must be recorded on time. Then it should be what? Understandability. It should be, this financial statement should be what? It should be understandable. You should do it, or you should prepare it in such a way that it makes sense. It is understandable. When somebody reads it, they should be able to understand what you are saying. Should be able to understand the financial. It shouldn't be too complicated. It should be simple enough. Good. So these are what we call the qualitative characteristics. Talks about relevance. Talks about faithful represented. Talks about that it might be comparable. It must have trends. It might be verifiable. I must be able to verify all the amounts on the financial statements. It might be timely. It might be on time. And it must make sense. It might be understandable. Good. Any questions on what we have discussed so far? All right, so I think we have discussed all this, the relevance and that. And then it's also one of the qualitative characteristics under relevance is it talks about materiality, that omission or misstatement affect the decisions of the users. So when you are preparing the financial statement, don't omit or don't misstate, don't lie about the amount, and don't omit stuff from it. Bring them all in. Bring them all in. Whatever happened, let us know exactly what happened during the course of the year. Record all the transactions. Record them appropriately and record them properly. It should be valid. And like I said, faithful represented also talks about the completeness, that whatever happened during the year should be, or whatever you record should be complete. You mustn't leave anything out. It might be neutral. You mustn't be biased. And then it might be free from material error. It might be free from material error. We are not saying that the financial statements are 100% accurate, but they must not be materially misstated. That's when the materiality comes in. So, for example, if the actual turnover of the company is 100 million, and when I'm preparing the financial statement, I made it 98 million. It's not, the 2 million is not too material, right? It's not going to affect the decisions of the user, because the materiality of the difference is too small. So we are not saying that the financial statement should be 100% accurate, but it should what? It should be free from material error. So the error shouldn't be too big. Like if something is 100 million, I mustn't go and say is 80 million. That 20 million difference is too big that it can actually affect the decision of the users of the financial statements, right? Good. So that is what those qualitative characteristics actually mean. Good. Any questions? Now, what are the elements of the financial statements? What are the elements of the financial statement? When you talk of elements of the financial statements, what are they? Who can tell me? Who can just give me one element of the financial statement?
The assets, the liabilities, equity.
Good.
Yeah, income.
Good. So those are the elements of the financial statements: the assets, the liabilities, equity, income, expenses. These are what we call the elements of the financial statements. Excellent, 100%. These are the elements. So now what we are going to do is that we are now going to delve into the elements to find out what is really an asset, what really is an expense, what is an income, what is equity, so that when we have a transaction, we'll be able to know that this transaction is an asset. This one is a liability. This one is equity. That is an income, or that is an expense. Before you be able to do that, before you be able to record the transactions accurately, you should be able to know what an asset is. Because if you don't know that this is an asset, how will you be able to record it correctly? So the framework now tells us or shows us how we're going to now we are delving into the definition of an asset, liability, equity, income, and expenses. Good. So it brings me to the next question. What is then an asset? What is an asset? Your definition of an asset will make me be able to recognize an asset and every time I have a transaction to know that this is an asset. And therefore, if I want to increase that asset, I must debit it. And if I want to decrease it, I must credit it. What is an asset? Yes? Any takers on this? Yes, we see.
Is it tangible items that are owned by the company and the economic benefit will flow to the company?
They are tangible assets that are owned by the company and that economic benefit will flow to the company. Good. Just that, is it only tangible assets?
No.
I think there's intangible assets as well.
Good. So then let's modify our definition. What then is an asset? It is
Tangible and non-tangible.
tangible and non-tangible. Yes. Continue. Tangible and non-tangible. Okay, Maria says it's something of value that you own. Okay, something of value that you own. Okay, I agree. Something of value that you own. Okay, like an investment, a current, non-current. Okay, Andrew says a resource that a company owns or control expected to provide future economic benefit. Good. Excellent. A resource that a company owns. So the fact that it makes a resource means that it is both tangible and non-tangible, right? That a company owns or it controls. Good. And is expected to provide future economic benefits. Good. How many of you know that the definition of asset has changed a bit from the one we used to know or the one we learned at high school? It has changed. The new framework has modernized it or has modified it a bit. At first, when I was studying, it used to be a resource controlled by an entity from a past event from which future economic benefit will flow. Now it's something different. It's the same principle, but the wording has changed a bit. But everything that you are saying is true. So it tells me that you know what an asset is. It is something of value that you own. It is true. Like an investment, which is true. It is a current and non-current, which is true. It's a resource, it is true. It is owned or it is controlled, it is true. And it's expected to provide future economic benefit. So everything so in accounting, what is important? Because remember, these days, I don't know whether, I mean, it's important for you to understand the principle. Once you understand it, you'll be able to process the entries. So that's what is important. Understand the principle for you to be able to process the general entries. Yeah, so everything that you have said, it is 100% right. Now let's look at what the textbook tells us what an asset really is. It says a present economic resource controlled by the entity as a result of a past event. So that is now that is what an asset is. They've shortened it, summarized it. A present, but everything we have spoken about is incorporated in this definition. The economic benefit is inside. The fact that you own is inside. The fact that you control it is inside it. Everything is encapsulated into this concise definition. A present economic resource controlled by the entity as a result of a past event, right? And they say that economic resource is a right that has the potential to produce economic benefit. So the fact that it is a resource means that economic benefit will flow. So even though they did not mention economic benefit flowing, the fact that it is a resource means that economic benefit will flow to the entity. And it is a present economic resource, right? It's a present economic resource. It's not something that you don't have. You have it now. Presently, you have it. It is controlled, also very important. It is controlled. That means the entity can restrict other people from using it. You control it. You control it. So even if you don't own it, but you control it, it is still an asset. So there can be an item that you don't own it. So legally, you don't own it, but you control it. It is still an asset. For example, who can give me an example of something that you don't own it, but you control it, which is an asset to you? Who can think of one example? You don't own it, but you control it. Who can think of one example?
I think of a hired office space.
You're hired office space. Good.
To run a business from it.
Good. Excellent. 100%. So something you have hired, like a lease, right? You have hired something, so it's a lease. You've hired it. So a lease is like that. You don't own it. You've hired it. You don't by contract, you don't own it, but you control it. So that higher space is an asset to you. You recognize it in your statement of financial position, and that is why there's a new lease statement called International Financial Reporting Standard 16, which says that if you have a lease, you are expected to recognize that lease in your statement of financial position, provided that it meets certain criteria. But we will talk about it, I think, sometime next week when we do the statement for leases, IFRS 16. Yeah, so very good. I like that. So something you have hired, something you have leased is you don't own it, but you control it. Therefore, it is your asset. You must record it in your statement of financial position. Good. So that is it now. So now let's look at, in order for me to know that you guys really know what an asset is, I've got 1, 2, 3, 4. I've got 4 transactions, and I want you to record them in the entities books. So I'm giving you just 3 minutes, and then we will discuss it. Purchase of inventory for 50,000. Purchase a vehicle for 150,000 for cash. Acquired investment of 20,000 using cash. Receive an option to acquire shares. The cost of the option is 45,000. How will you record this in your books, which will eventually end up in your financial statements? Cool. So okay, Andrew has put some journal entries on the chat. So the first one says journal entry to record purchase of inventory for 50,000, debit inventory and credit payables, right? So you debit inventory of 50,000, credit payable of 50,000. What about the next one? Purchase of vehicle for 150,000 for cash. Purchase of vehicle for 150,000 for cash. What would be the journal entry? Anyone? Purchase a vehicle
Debit
for
bank 150,000. Credit vehicle 150,000.
Are you sure? You have purchased a vehicle for 150,000.
No, sorry, it's vice versa actually.
the other way around.
It's the other way around. Yeah, the
Yes,
money is
the other way
coming
around.
out of the account, company's
Yeah.
account. So yeah,
Good.
credit bank, debit
Yeah.
vehicles.
Good. Excellent. Excellent. And then the next one, acquired investment of 20,000 using cash. Acquired investment of 20,000 using cash. And you say debit investment and credit cash. Good. So we debit investment because you've acquired the asset, which is investment, and because you got it for cash, cash which is an asset is going down, so you credit it. So anytime you acquire an asset or you increase your asset, it's a debit. So you debiting your investment. And anytime assets goes down, it's a credit. So when you acquire the investment, you debited the investment. And then you credit what? The cash, because cash, which is an asset, has gone down. Because remember, you use the cash to pay for the investment. So it's debit, investment, and credit, cash. Debit, investment, credit, cash. Good. Then the very last one, receive an option to acquire shares. The cost of the option is 45,000. What is the journal entry? What is the journal entry? You receive an option to acquire shares. The cost of the option is 45,000. Debit, Maria says debit share capital and credit cash. Why am I debiting share capital? Why am I debiting share capital? You took a chance. Okay. All right. We'll discuss it. Anyone else want to try the option? So first of all, an option is what is an option? Is an option an asset? Good. Andrew said yes. Why is an option an asset? Why is an option an asset? We just define what an asset is. Why is an option an asset? It's a financial instrument. Okay. Oh, that is a big word. That is a big word. Can you break it down? An option, it is a financial instrument. It's too big for me. Can you break it down? For people who don't understand what a financial instrument is, for them to know what a financial instrument. An option. Is it an asset? And if it's an asset, you said yes. Yes. Why? It's an investment. I want the actual investment of some sort. I want the actual meaning of the word option. So basically, an option is a right. A right is a right. If I give you an option, it means I've given you a right. And we did say that the definition of an asset is what? It's either a tangible asset or an intangible asset. So a right is an intangible asset. If I give you a right to do something, I've given you some form of a resource or a benefit. You have the right to be able to go and explore for oil in Angola. You have the right or the license for you to be able to drive a car. You have the right or you have the option to buy a share. If I give you the option to buy a share, I've given you the right to buy a share. So that right is an asset. I've given you a benefit. Whether you exercise it or not, that one I don't know. You can either decide to exercise the option or not. But the fact remains that the option is an asset because it gives you the right to do something. So that becomes an asset. So the journal entry would be debit option and credit bank for 45,000. Debit, the option asset, 45,000. Credit, cash or bank, 45,000. Good. Now, what is a liability? What is a liability? The framework says that, yeah, it's a present obligation. It's a present obligation of an entity to transfer an economic resource as a result of a past event. A present obligation. So the liability, that has to be a present obligation, otherwise it will not be a liability. You have to be obliged to do something. A present obligation of the entity to transfer an economic resource. So anything, any obligation that makes me to transfer an asset is a liability. Anything that gives me the obligation for me to transfer an asset in my entity is a liability. So we can give examples of liabilities. A loan, for example, is a liability. Why is a loan a liability? Because it gives me the obligation that later on I must transfer cash to pay for that loan. The fact that I need to transfer cash from my company to pay that loan, it makes a loan a liability. Can anyone also think of another liability that I've not mentioned here? Any liability that you know? And let's analyze it to see if it really means the definition of a liability. A lease liability. If you have a lease, you are liable to be paying what? The monthly lease expense. So that becomes what? A liability. What else? We already said a loan. You have to settle the loan. You have a present obligation to settle the loan. So the loan is a liability. A bond. If I have a company and I have issued a bond, I have to transfer money at some point in time to settle the bond. And that makes it a liability. So anything that will eventually result in me having to transfer money to settle it is a liability. Good. A liability can either be by contract or it can be what? Constructive obligation. By that, it means that you can create an expectation on the part of people or customers. And if you create an expectation, that expectation you have created can also be an obligation. For example, if you create an expectation that if Macro, for example, creates an or Checkers or Pick and Pay creates an expectation that every time that goods are defective goods are returned, you are going to get a refund. You have created an expectation on the part of the customers that anytime that there is goods are returned, they're going to get a refund. So that the fact that you've created that expectation on the part of the customers makes that transaction have a liability component, right? So a liability can either be by a contract or by what is called a constructive agreement. You create an expectation, and once the expectation is created in the minds of the people, that is also an obligation. So I'm giving you 3 minutes. Let's look at these 3 general entries and come up with the solution. Settle a loan of 45,000. What will be the general entry? You acquired a loan of 150,000. What is the general entry? Interest on a loan of 15,000 was incurred during the year. What is the general entry? Let's give ourselves about just 3-4 minutes, and then we'll discuss it together. Okay, right? I think we can discuss it now. So the first one, settle the loan of 45,000. What is the general entry to settle a loan? What is the general entry to settle a loan? Okay. My Harbour said debit loan account and credit bank. Does everyone agree?
Yes.
Good. So you debit loan account and you credit bank. Why am I debiting loan account? Because I'm settling a loan. If a liability decreases, it's a debit. When a liability decreases, it's a debit. So I debit a loan account, and because I'm paying with cash, asset is going down, so I credit cash. Good. Excellent, guys. Thanks for that. Good. And the second one, acquired a loan for 150,000. What is the general entry? Acquired a loan for 150,000. What is the general entry to acquire a loan? Debit bank. Maria says debit bank and credit loan account. Excellent. Debit bank. Why would I debit bank? Because if I have acquired a loan, it means what? I've got cash. I went to the bank to get a loan. The bank has given me cash, so I've increased my cash. So debit bank. Then what do I credit at the same time? What? I need to pay. It's a liability. I need to pay them, the bank, at a later stage. So I credit loan account. I credit loan account. Does that make sense? So debit bank, because I've got cash, I've got a loan, and credit what? Loan account. Credit the loan account. Good. Thanks, Maria. And the last one, interest on a loan of 15,000 was incurred during the year. Interest of 15,000 was incurred during the year. What is the general entry? General entry to account for interest expense. Anyone want to try? General entry to account for interest expense.
I'm just guessing that you'll debit interest and credit the liability.
Good. That's it. That's it. Because if you have not paid for it, then you debit the interest and you credit the liability, the interest liability or interest payable. But if you have paid for it, then you debit interest expense and credit bank. So it's the same logic. The same logic. Excellent, guys. Excellent.
Sorry, can I ask? Would
Yes.
it make sense if I said credit accrued expense? Does it make sense?
Yes, credit accrued expense. Yes, it makes sense. Sometimes some people will say the debit credit interest payable or accrued expense is the same thing. Yeah, or credit accrual for expense or accrued expense. It's the same thing. Yeah, it's the same thing. Good. Any other questions? Cool. Let's move on. Then what is equity? Who can tell me what equity is? What is equity? Any takers on this? What is equity? That is the third element of the financial statement. When we say equity, what do you understand by it? Mwehabo, you want to try?
I would say I know that equity is what the owners of the business own, but I don't know how to explain it.
Okay.
It's what you own within a company. It could
Yes,
be shares,
that's right.
it could be money. I'm not sure if it's not money per se, but shares. It's the value that you own in a business.
The value that you own in a business, that is true. The value that you own or the value of the company. The value of the company. The value of the company. So like I said yesterday, if you want to know the value to get an approximate an idea of how much the company is worth, go and get your statement of financial position and look at the equity. How much equity is certain is certain, it gives you an indication of how much the value of the company may be. Because why is that? Because of the accounting equation that says that assets less liabilities gives me owner's equity. That means if I sell all my assets and I get the money and I pay all my liabilities, whatever is left is my equity. And the same thing happens when a company is being liquidated. When a company goes bust and they are liquidating the company, they sell off all the assets. Whatever money that they get, they settle all the liabilities. And whatever money they have left, they give it to the owners, isn't it? That's the owner's equity. So my statement of financial position tells me that if I sell, these are my assets, these are my liabilities. Asset less liability gives me owner's equity. It's telling me that if the company should be liquidated today and I sell off all my assets and I use the money to settle all my liabilities, the people that I owe money to, whatever is left is basically what should be distributed to the shareholders. So basically it tells me that that is how much my company is left, because the assets are mine. The liabilities belong to somebody else. So therefore, my assets less my liabilities gives me the value of the company or the owner's equity. Good. So it says that equity is the residual interest in the assets of the entity after deducting its liabilities. So when I deduct my liabilities from my assets, whatever is left is my equity, my owner's equity. So whenever you are preparing financial statement, we are preparing the statement of financial position, it must balance. If your assets less your liabilities is not equal to your equity, then your financial statement does not balance. Then your financial statement does not balance. Then there's a problem. You have to balance it. Okay, good. So let's just do only the first example. the journal entry to issue shares to another company for 75,000. What is the journal entry? I'm a company, I've issued shares to another company for 75,000. What is the journal entry that I'll put in my books for the company that issued the shares? What would that be? I've issued shares to another company for 75,000. What is the journal entry?
But I can't see the question. Sorry, I don't know if it's my network.
Okay. You issued shares to a company for 45,000, for 75,000. What is it? We're just doing the first one. Yeah. You issue shares to another company for 75,000.
I think I'm debiting equity. DR, yeah, and then crediting. What am I crediting? I don't know what is the other account that I have to credit.
Okay, so if I issue shares to a company, what do I get in return for issuing the shares?
You get money. So my guess would be debit bank and credit share capital.
Exactly, 100%. Debit bank and credit share capital. Debit bank and credit share capital, because as I issued I got money, so I increase my cash. So I'm debiting my cash or my bank. Then because I've issued shares, I credit share capital. It's as simple as that. Good. Now, then what is income? We're almost done. We just left with income and expenses. What is income?
It's
Anyone
money
wanna try?
that you receive.
It's money that you receive. It's money that you receive. So does it mean that if I sell inventory and I receive money, that money is that is income? The money received. We have to say the money received. Okay. So. Money received. What if I don't receive money? Does that mean I didn't get income? If I sell something on credit, does that mean that it's not income because no money was received? Income? Okay. Who can give me examples of income? What are some examples of income?
Can we say revenues income?
Sorry?
Rent income.
Rent income, good. So rent income is an example of an income. Rent income. What else?
Interest received.
Interest received, good, excellent. What else?
Profit on sale of non-current or current asset.
Profit on sale of non-current asset or current asset, good. Good, so these are income. What is the definition of income? If what you have mentioned to me is income, then what is the definition of income?
Money
Does anyone?
received for
Yes?
a service rendered.
Sorry?
Money received for a service rendered.
Money received for service rendered. So if I have rent that I have earned, but I have not received the money, does that mean that it's not income? Because you are saying your definition is money received for service rendered. Is it always that you have to have money before you can recognize income?
Income, it can be an income if there is money owed to you as well.
Okay, so there can be income when there's money owed to you as well. Okay, good. So everything you have said is like partly is there. I just want something to join together, but everyone is seeing a part of it. You're not putting the whole thing together. Yeah, but everything, like the idea is there. The example tells me that you know what income is. You know what income is, and like I said earlier, the most important thing is what is the principle that you understand. There's no point to crime. You need to understand. The understanding is more important than than learning the definition off by heart. So I know that you do understand it. Good. So they define income as increases in assets or decrease in liabilities that result in increase in equity other than those relating to contributions from holders of equity claims. Yo, that is a mouthful. But all that they are saying is that whenever there is an increase in an asset, there is income. Whenever there is a decrease in a liability, there is also income. Right. So some of the examples that we gave, we said that what? Profit on sale of a non-current asset. When we have a profit on sale of non-current asset, what has happened? We've actually got what? More money. And therefore that profit becomes what? An income, because it is as a result of what? An increase in an asset. We sold the vehicle, or we sold the vehicle, and we got money for it. And because the money we got was more than how much it cost us to sell the vehicle, we have an income. So profit on sale is what? The proceeds less the cost of the vehicle gives us the profit on sale. So because the proceeds is more than the cost of the vehicle, we have what? An income. There has been an increase in assets. So is a decrease in liability. A decrease in liability. So let's say we're supposed to pay interest of 50,000, but instead we ended up paying interest of only 10,000. The fact that we paid less, it means that what? We've received an income. We've received some form of what? A benefit. So income, you can look at income as what? A benefit. So anytime you receive a benefit, it's an income. That's what it means. So example is receive profit from the sale of vehicle of 130,000. Who can give me the journal entry for that? Receive profit from the sale of vehicle of 130,000. What will be the journal entry? What is the journal entry? Profit from sale of vehicle of 130,000. Profit on sale of 150,000. Who can try it? I got a profit on sale of 150,000. Profit on sale of fixed assets 150,000. What is my journal entry? Yes, looks like somebody wants to try. Okay, foreign exchange gain of 5,000. Who can give me the journal entry? Foreign exchange gain of 5,000. I am exporting some inventory overseas, and it ended up me getting a foreign exchange gain. What is the journal entry? Okay, the third one, received dividends from investment of 112,000. I received dividends from investment of 112,000. What is the journal entry? Another one, someone must tell me. That is the easiest of them all. I received dividends from investment of 112,000. If I receive dividends, okay. Oh, sorry. Mahabo has said something. Debit bank credit asset. Which one was that? Debit bank credit asset.
It's the first one.
Oh, the first one. The receive profit from the sale of a vehicle. Debit bank credit asset. Okay. And then the second one is what? Credit the profit amount. And what do you debit?
I wanted to say you create the asset with the amount of the profit that you got from the sale of the asset.
Okay. And then the other leg?
The second one, I don't even know where to go.
Where to start from? Okay, so the second one is what? Foreign exchange gain of 5,000, right? So you have the foreign exchange gain of 5,000. You can debit bank and credit for and credit foreign exchange account or credit income from foreign exchange. It's not important to me as to what is important to me is the logic, is the thinking behind. What am I debiting? What am I crediting? Is it an asset? Is it an income? Where's it going? Where is it going? So that is where I'm trying to gauge, so that I'll be able to know whether, you know what, in terms of when it comes to the transactions, you actually be able to process them. Remember, from next week, we're now going to go into each standard and delve deep into inventory, financial instruments, property, plants and equipment. So you need to be able to be very, very good with journal entries, understanding what to debit, what to credit. It's very, very important. So let's start with the last one, receive dividends. When I receive a dividend, what do I debit? I've received dividends of 112. What do I debit? I've received dividends. I'm a company, I've received dividends for my investment. What do I debit?
Bank.
I debit bank. Good, excellent. What do I credit?
Gordon,
Yes.
the end of info is up.
Oh, sorry.
I don't know whether it's a historical end or what.
I think she has spoken already. Impo, please, you
Okay,
may speak.
may Gordon, don't laugh at me, but I always get confused when I'm treating transactions about income. I always don't know
Okay.
where income has to be increased.
Okay.
Like my FAC1501 just disappears.
Okay. All right. No. Nobody will laugh at you. We are here to learn. We are here to study. Nobody will laugh. This is the platform for you to ask all your questions. Remember, if you don't ask it here, you're gonna write it on the paper. So it's better you do the studies here. You ask all the things that you are not sure about. But an income is an income, and an income will always increase with a credit balance or with a credit entry. So whenever there's an income is like think of income as like revenue. So even though revenue is a sale of something, but income is also like revenue. An increase in income is a credit, and you can call it credit to income or something, because in your statement of profit and loss and other comprehensive income, you've got what? You've got it started off by revenue. Then you have cost of sales. Then you have your gross profit. Then you have what? Other income. So these things that we are talking about, these are what? Other income. And they increase with what? With a credit balance. They increase with a credit. So whenever you have an income, it is a credit. You credit income. You credit income. Then you can debit bank or you can debit whatever. But the credit will always be you increase income. Then if it's a loss, it's the other way around. You debit the loss. You debit the loss. Yeah. Okay, so the last one, it says I received dividends of 112,000. And someone said it. What do I debit again? Dividends received. What do I debit?
Oh, we debited bank.
We debit bank. Good. And what do we credit?
We credited. What was it? Dividends. Yes.
Yes, we credited dividend income or dividend received. You must always qualify your account. Is you credit dividend income or you credit dividends received. Right. So that one is perfect, 100%. Why is it? Because I've got money. I've received dividends for my investment. I've received money. So I debit my bank. What do I credit? It's an income. right? I receive money, I've got an income. So I debit my bank, I credit my dividend receipt or dividend income if you want. Then the second one, foreign exchange gain of 5,000. So normally when you have a foreign exchange gain, it depends on the transaction, but the fact that I've got a gain, it means that what? I credit gain or foreign exchange gain or foreign income. You call it, I credit foreign income and I debit maybe bank. For example, maybe I was paid, or if I'm not paid now, what do I debit? I debit a receivable because I'm going to be receiving the money later on. So I debit a receivable or a debtor, foreign exchange debtor, and I credit what? Foreign exchange gain or foreign exchange income for the second one. And the first one, receive profit from a sale of vehicle. If I receive profit from a gain of from a sale of a vehicle, that profit is what? It's an income. So I credit income, 130,000. Then what do I debit? Maybe if I was paid immediately, I'll debit my bank. If the money hasn't come now, I debit what? A receivable. So always when there's an asset, it's two things. Either I receive a bank or I receive some form of a receivable, something I'm going to get in the future. And that receivable is what? Is the right for me to I have a right to receive the cash. So that's what makes a receivable or a debtor an asset. So a debtor is an asset because of the fact that I've got a right to receive money at some point in the future. That's what makes a debtor to be an asset. Good. Any questions before we wrap up with some, I think, two slides or so? Any questions? So far, so good. Guys, ask the question. There's nothing like a stupid question. And always pre-read. Go through the work before you come so that you'll be able to ask the areas where you are not sure. And then the last one, the last element is expense. What is an expense? Let's give ourselves, give me two examples of expenses. If you give me an example, I will know that you know. What is an expense? Maria? I'm just picking on you. What is an expense?
Money that you paid for acquiring a service.
Yes.
Or a subscription.
Yes.
Some sort,
yeah. So basically, an expense is anything that you have incurred, which is what should I say? So so it's not all the time that you have to pay. Sometimes you incur it, you haven't paid it, you're gonna pay it later. It's also an expense. For example, if I buy stationery on credit, it's an expense. Or if I buy stationery and I pay for it immediately, it's also an expense. So I don't have to pay for it. So far I've incurred it, it is an expense. So that is what it's like salaries. If I've incurred a salary, but I've not paid my employees, it is still an expense to me. The fact that I have not paid doesn't mean it's not an expense. I've incurred it, so it's an expense. Good. So it says a decrease in assets or an increase in liability. So an expense is the opposite of an income. They're opposites. The income says an increase in assets. An expense says a decrease in asset. Income says a decrease in liability. Expense says an increase in liability. So they work in opposite. So for example, a decrease in assets. What is an example of a decrease in assets? What is an example of a decrease in asset? A decrease in asset. It's a decrease
in money.
Sorry, come again?
Paying out money from your account.
Paying out money, good. Paying out money. So instances where I pay out money, it could be an expense. If I buy inventory, or if I buy stationery, sorry, if I buy stationery, if I buy some toys, if I buy what do you call it, coffee and those things for the office, if I pay salaries, you know, all these are what decrease in an asset. My money is decreasing because I'm paying someone, I'm paying for something. So the mere fact that my money has gone down as a result of the payment is an expense. Depreciation is an expense. I had an asset. As I'm using the asset, the value or the performance of the asset is going down. That is an expense. So that's what makes depreciation an expense. It's the devaluation of the asset. The fact that the asset value is going down, it makes depreciation to be an expense. You see, interest expense. Interest expense is an expense because I've incurred it. It will result in me having to pay some money to the person that I've lent. I'm loaning or I have a loan from. Stationery, an expense. A loss on sale of plants is an expense. A loss on sale. The profit on sale was income. The loss on sale is an expense. Why is a loss on sale an expense? Because it's an increase in the liability. The fact that I've lost something means that it's resulting in an increase in a liability or a decrease in an asset. Actually, it's more of a decrease in an asset than an increase in liability. The loss of a sale of plant is a decrease in the asset. Because I sold the asset, I was expecting to get more. Instead, I got less money for it. So I got less money. I decreased my asset, and therefore the loss on sale becomes an expense. Salary is also an expense. So anything that will result in a decrease in an asset or an increase in liability makes it an expense. For example, interest. Interest will result in an increase in liability. If I incur interest, it means that what? My liability is increasing. Anytime I incur interest, it means that I have to be paying the lender or the creditor. And that means that what? It is an increase in liability. Good. We're almost done. And then we have what is called recognition and derecognition criteria. What is a recognition? So all these things that we are learning is all about what? The framework. How do we prepare? What are the things that underlie the preparation of a financial statement? So the thing we started, the qualitative characteristics. Financial statement has to be relevant. They need to be faithfully representing. They need to be comparable. They need to be timely, and all those things are underlining. Then we came to the definition of an asset, because your financial statement, that's all it's made up of: an asset, a liability, equity, income, and expenses. So we have to know what they are, and be able to prepare or be able to pass journal entries for us to be able to understand them, so that tomorrow, if somebody come and tell us a transaction, we already know that, oh, this is an expense. This is the journal entry. This is equity. This is the journal entry. This is an income. This is the journal entry. This is sales. This is the journal entry. So it makes us what? A better accountant, because we understand the basic elements of the financial statement, which helps us to be able to prepare them. Right? Now, the last bit is that the framework says that you must know what is called what is recognition. In other words, it says that for me to be able to record something on the statement of financial position or on the profit and loss, I must recognize it. Right? Recognition means that what? I must have a value. So if there is something, if there's a transaction and the transaction that does not have a value, I cannot recognize it. Because what value am I going to put there? So I must recognize it. And when the asset or the liability is no more, I must derecognize it from the balance sheet or from the statement of financial position. So let's say I had a vehicle. Now I sold the vehicle. The vehicle is no longer there. I need to de-recognize the vehicle from my balance sheet. So who can give me the journal entry to de-recognize a vehicle? I'm removing the vehicle from my balance sheet. What is the journal entry? We've processed a lot of journal entry to recognize asset, recognize the liability. Now, what about if I'm de-recognizing the asset? What is the journal entry? Debit vehicle, credit bank. Good. Debit vehicle, credit bank. Because I'm removing the, oh, no, sorry. I'm making a mistake. That was something else. If I'm de-recognizing, if I'm taking the vehicle from the balance sheet, what is the journal entry? Or for my financial statement, what is the journal entry? Remember what you did when you brought the vehicle in. Now I'm de-recognizing it. What is the journal entry? Good. Mahabo is saying that credit the vehicle and debit bank. Good. Because when I sell the vehicle, I'm going to get money. So I'm debiting my bank. And because I no longer have the vehicle in my balance sheet, I need to de-recognize it. I need to credit the vehicle to take it out. To take it out. So whatever you did initially to bring it in, you reverse that transaction. When I was bringing it in, debit vehicle, credit bank. Now that I'm taking it out, credit vehicle, debit bank. You see, good. Recognition and de-recognition. And then we have measurements. So whenever you are recognizing the transaction in your statement of financial position, you have initial measurement. And then you also have what we call subsequent measurement. Initial measurement is when you initially bring the item in the statement of financial position. But whilst it's there, we have what is called subsequent measurement. For example, I have a vehicle. The standard tells me that the standard for property, plants and equipment tells me that when I recognize a vehicle, I must recognize it at historical cost, the cost that I initially bought the vehicle for, right? So I say debit vehicle, credit bank. But subsequently, after I've recognized it, how do I treat the vehicle going forward until the vehicle is fully depreciated? So I may have to depreciate it. I may have to revalue it. I may have to fair value it. You know, all these things are what is called subsequent measurement. And we're going to be dealing with all these things when we start next week, looking at inventory, financial instrument, PPE, leases. All of these standards have got their initial measurement and subsequent measurement. So initial measurement is when I initially recognize the asset in the balance sheet. Now, subsequently, once the item has now been put in the balance sheet, going forward, how do I treat it? How do I treat it? So all these things are things that we're going to, and every standard is different. What the property, plants and equipment standard will tell you about how to do initial measurement and subsequent measurement is different from what the standard for financial instrument will tell you. And we will get to understand why. Why does financial instrument tells us to do it this way, and why does property, plants and equipment tells us to do it that way? You get it? Good. So that brings us to the end of the framework for the preparation of financial statement. Any questions? We have just 1 minute. Any questions?
Where do we go to access the recordings?
I think Avasia said something here. He said that he said it's going to be put on the, he said recordings will be uploaded on the UNISA on the UNISA Gauteng region YouTube after they have edited it. So the Gauteng UNISA Gauteng region YouTube is going to be there. Yeah, it's going to be there.
Okay.
Okay.
Thank you.
Any other question? Any other question? Okay, if there's no question, I will see everyone tomorrow.